Welcome to this explainer. Okay, let's just dive right into a flashing red warning signal that is somehow hiding in plain sight within the global financial system. We're talking about a massive $2 trillion asset class where the cracks are becoming absolutely impossible to ignore. And you have to remember, this isn't just Wall Street money we're talking about here. This is pension funds, massive institutional portfolios, and everyday retirement savings. But to truly understand the quiet damage happening behind the scenes, we have to start by looking at a number that dictates the very foundation of our entire economy.
Most folks completely ignore this number, but honestly, it represents the very price of money itself. The 30-year Treasury yield recently hit its highest level since 2007. And, well, we all remember what happened to the global economy shortly after that, right? For nearly 2 decades, borrowing money was practically free. But the bond market is supposed to be the sensible one. It's the adult in the room, if you will. And looking at this metric, it's pretty clear the adult in the room has just pulled the plug on the party.
And the data brilliantly illustrates that this isn't just an isolated American issue. Just look at the global landscape. You've got the US hitting highs not seen since 2007, the UK since 1998, Germany since 2011, and Japan? Japan is at an absolute all-time high. When 4 of the world's largest sovereign bond markets surge like this simultaneously, something incredibly serious is brewing underneath the surface. The global baseline for borrowing is shifting violently, and it sets the stage for everything else we're about to uncover today.
Part 1. The yield equation. How bonds actually work. To really grasp the quiet damage happening in the background, we need a quick crash course on the mechanics of bond yields. Don't worry, we're going to keep it straightforward. At its core, a bond is simply an IOU where buyer bidding determines the yield. It's driven by a few key things: Fed rates, inflation, debt supply, and of course, buyer demand. There's really just one golden rule you need to keep in mind. When the price of a bond goes up, the yield goes down. And when the price goes down, the yield goes up. It's an inverse relationship, kind of like a seesaw, that essentially acts as a real-time thermometer for the economy.
Now, different maturity lengths tell us completely different stories. The 2-year tells us what the Fed is doing right now in the short term. The 10-year acts as your standard global benchmark. But the 30-year yield, that one is particularly revealing. It is essentially asking a very stark, fundamental question about long-term financial trust. Do you trust America's finances over the next 3 decades? Right now, the market is saying that trust demands a much, much higher premium.
So here is where it gets real. We need to talk about SOFR, or the Secured Overnight Financing Rate. You can think of SOFR as the overnight receipt for the entire U.S. financial system. In early 2022, it was practically zero, free money. But by mid-2023, it rocketed past 5%. Because this massive spike was so sudden, it instantly squeezed cash flows for literally anyone holding floating rate loans, because your monthly payment automatically adjusts to this exact number.
Section 2. The private credit trap, when the math breaks.
Which brings us directly to a $2 trillion asset class known as private credit. And in this space, the margin for error is rapidly shrinking as that SOFR rate stays elevated. Now, private credit is absolutely vital for complex, mid-sized companies that fall somewhere between needing a standard small business loan and issuing public bonds on Wall Street. But here is the critical takeaway. Because these loans don't trade publicly, meaning there is no daily price to look at, and because they are mostly floating rate, they are highly vulnerable to SOFR increases. The companies relying on these loans are feeling the direct weight of those higher interest rates every single month.
Let's look at how this trap actually springs in the real world. Take the software company Pluralsight, for example. Back in 2021, they were required using over $1 billion in floating rate private credit. When rates were near zero, the math worked totally fine. They had plenty of breathing room. But when SOFR hit 5%, they were absolutely crushed by the interest payments. The debt service simply devoured their cash flow. By August of 2024, the lenders had to step in, convert the debt, and take 85% ownership of the company.
And listen, Pluralsight wasn't just some one-off anomaly. It was just one borrower in an enormous stack. As JP Morgan CEO Jamie Dimon recently pointed out on an earnings call, when you see one cockroach, there are probably more. And let's be honest, in financial markets, you never want to hear the word cockroach. The data completely backs this up too. Fitch's private credit default rate recently hit a record 6%, the highest since the index even began, in a market that has grown 10 times over since 2007. The pressure is undeniably building behind the walls.
Section 3. The accounting illusion. The magic of PIK.
So, you're probably wondering, if defaults are rising so fast, why isn't there widespread panic in the markets right now?
Well, the answer lies in a brilliant but honestly highly dangerous accounting trick. Meet PIK, or payment in kind. This is an accounting feature that allows struggling borrowers to literally skip their cash interest payments. Instead of paying actual cash, they just take that unpaid interest and slap it right onto the total principal balance of the loan. By rolling the unpaid interest into the principal, the loan still looks like a perfectly performing asset on paper, because, technically, no cash payment was ever officially missed.
The absurdity of this cycle is just staggering when you break it down. Step 1, rates rise. Step 2, the borrower struggles, so they use more of this PIK feature to survive another quarter. Because the loan is still considered performing, the lending fund reports this unpaid interest as income. And here's the really crazy part. Legally, these funds must pay out real cash dividends to their investors based on this phantom PIK income they never actually collected. They are literally mailing out hard cash based on money that only exists on a spreadsheet. It is financial magic, right up until the rabbit refuses to come out of the hat.
The actual numbers behind this illusion are pretty wild. There has been a massive 72% explosion in PIK loans just since the end of 2021. For some of the major players out there, PIK makes up over 14.5% of their income share, and when the illusion finally breaks, the impact is incredibly severe. In just one single month in 2025, there were 11 defaults, which is nearly double the historical monthly average. But here is the stat that should really grab your attention. Over 60% of those recent defaults stemmed directly from loans utilizing these hidden PIK features. The safety net is rapidly becoming a straitjacket.
Section 4. Hitting the maturity wall. The inescapable reckoning.
Because private credit relies heavily on what are called Level 3 assets, which essentially means they are valued by internal models instead of open, daily public markets, lenders can easily paper over these massive losses for a while. But they can only do that until the bill actually comes due. And that bill? It's an $85 billion maturity wall hitting between 2026 and 2029. This is the moment of truth. All those companies that borrowed at near-zero rates and have been relying on accounting tricks to barely survive are going to be forced to refinance at today's brutally high costs. You simply cannot model your way out of a hard deadline.
So, I want to leave you with this thought, which is perfectly captured by our source material. You can hide a loss in an accounting line, you can roll unpaid interest into a bigger principal, but the math is still the math, and bad math doesn't just disappear. When this massive maturity wall finally arrives, will this bad math trigger a reckoning that we can no longer hide from? Thank you so much for joining me for this explainer. Keep your eyes on those yields and always keep questioning the math.